Hello, everyone, and welcome to our Solo 401k and Self-directed IRA live Q&A. We're excited to have you here with us today. My name is Leah with Sense Financial. We are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. I'm here today with Dmitry, who will be answering your questions. Dmitry is our president and founder of Sense Financial. Dmitry began his career in financial planning and real estate investing in 2000 and is a licensed California real estate broker. He holds a designation of Certified IRA Services Professional from the American Bankers Association, and over the years, he has taught hundreds of investment and financial planning seminars and mentored thousands of investors. Welcome, Dmitry, and thank you for joining us today.
Leah, it's great to be here. Thanks for hosting this, and looking forward to diving in.
Absolutely. We'll go ahead and get started with our first question. We have our first question from Gloria. She's asking, what happens if I run out of cash to satisfy the RMDs because of illiquid investments?
A good question, Gloria. RMD is an important question, and the bottom line, to prepare for the RMD, you have to plan for it. So you have to plan in advance. You probably don't want to start thinking about RMDs when you're over 70. You probably want to start thinking about your RMDs when you're perhaps in your 50s or 60s at the very least. Ideally, you want to create a portfolio of assets inside of your self-directed retirement accounts that provide passive income, whether it's several rental properties or perhaps a portfolio of trust deeds or private loans. But if you come to the situation or find yourself in a situation where you have to take an RMD and you run out of cash, well, if it is an IRA, that's also important distinguish there. If it is an IRA, if you have other IRAs, you can actually satisfy the RMD by taking your distribution from other retirement accounts. However, if it is a solo 401k, RMD have to be taken just or calculated just for the solo 401k specifically, regardless whether you do have other IRAs or not. So again, if you find yourself in a situation where you're forced to take RMD and you have no cash left, what you can do is you can take what's called a in-kind distribution. So basically you can pull a portion of an asset or entire asset out of your retirement account instead of pulling out the cash. If it is a rental property, investment property as an example, you can potentially take 25, 50, or maybe even 100% of the property out as a distribution, or if it is a trust deed. Now, you have to appraise that asset or get the valuation for that asset because the distribution will be taxable event. It's going to be a little bit trickier if you did that, partial distribution, because you're going to have to track all of your income and expenses and split them accordingly to the ownership percentage. So again, if you're pulling out 25% from your self-directed solo 401k of, let's say, a rental property, then from that point on, you're going to have to split every 10, 25, 75, all the income and expenses. But to everyone who's listening, it's very important that you plan for it ahead of time.
Thank you, Dmitry. Our next question is from Howard. He asks, what happens to my Solo 401k if I get employed?
Another good question, Howard. If you get employed, just by the fact that you get employed, nothing actually happens to the solo 401k. In fact, it is really irrelevant whether you're employed elsewhere or not. The eligibility or a qualification for a solo 401k is that you have to be either self-employed or own a business without full-time employees. And we have many of our clients who are running businesses full-time or self-employed full-time. We also have many clients who not. They might have something on the side. Maybe they're flipping a property. That might be just as little as one property a year, or maybe they job and they have their real estate license, and maybe they're using that license just for themselves. They might, or maybe for some relatives perhaps, they might be only selling one property a year. So but if your self-employment activity completely stops, if there is no self-employment activity whatsoever, then technically you're no longer eligible for solo 401k and you need to explore other options. So again, if you just get employed and continue your self-employment, you've got nothing to worry about this. But if you completely stopped your self-employment activity, then give us a call and let's discuss what your option is.
Liz is asking, when is the deadline to convert traditional IRA funds to Roth funds? in my solo for.
When is the deadline to convert to Roth? Okay, there is no deadline. You can do the conversion anytime. However, if you wish conversion to be effective for this year, 2025, then you have to convert this year, because conversion is effective on the date that you're making that Roth conversion. So if you convert it anytime before of 31, it will be effective for 2025. If you do the Roth conversion on January 1st, 2026, then it will be reported for the year 2026. So again, and perhaps you left out that part. If you do wish to the conversion to count for 2025, then you have to do it this year. In this case, deadline will be 12/31.
The next question is from Danielle. They're asking which broker house is best to use.
Danielle, also it will help if I knew if you're referring to self-directed IRA or solo 401k. If it is an IRA, actually that's going to be challenging, because most brokers now, they for some reason, they don't want to provide brokerage accounts for checkbook IRAs. I believe there's one or two that you still might be able to do that. But as far as the solo 401k, you can use any brokerage of your choice. It's pretty simple to open a brokerage account for your self-directed solo 401k. We don't have a favorite because it really depends on you. There might be, say, Fidelity might be a favorite for some people, but other people might like Schwab more. So it really depends on you. It depends on your taste and on your perhaps personal experience, your maybe the goals for that particular account, what it is that you want to do. But we do not have any favorites here. You can use any brokerage of your choice, and we do provide instructions for how to open a brokerage account for your solo 401k. You just have to log into the client portal, go to the setup section, and then click on banking brokerage, and you'll see there's about a dozen choices there that we tell you how to open the account. You need to open a specific type of account for the solo 401k, so you don't want to just call them. You want to reference our client portal, as this will ensure that you open the right type of account for your self-directed solo 401k.
Our next question is from Josh. Can you talk more about the year-end to-dos?
Sure. Before I jump on this question, I just want to remind you guys that you do have the opportunity to also ask questions live. You can type your question in the chat or whatever section there. And once we finish with the pre-submitted questions, we'll go to your questions live. And I want to encourage questions, because not only you will be learning, but also other people who are on the call. Those people who will be watching recording, they're going to be learning from your questions too, because they might not think of that question, but you asking, that will make them think. They'll learn something. And I always tell my clients, look, the easiest way to avoid making a mistake is to ask a question. And you don't want to be asking a question after the fact. You want to ask the question before doing anything. If you're not sure, ask the question. That's why we're here for. Welcome all the questions, so do that. Now, in addition to this, sometimes questions are a little bit unclear, or perhaps not full. So if I'm going to do my very best to discern what you're asking, but that may not always be the case. So if I answer the question and maybe I'm missing something, you can ask a follow-up question again by typing it live here. Just back to your question about year-end to-dos. Well, we created a comprehensive resource for both self-directed IRA clients and also for self-directed solo 401k clients. What you want to do is, I can go over all the items here. I don't even have them all in my head because there are several of them. But what you can do is use the resource. It is easily accessible. You can go to our website, SenseFinancial.com, and then click on solo 401k, for example, and on the drop down, click on the year-end items. or checklist. And that will give you a comprehensive list of what needs to be done before the end of the year. Some of those items may or may not apply to you, but you do want to be aware of those items, because time is running quick. We are just about a little over a week away from Christmas, and things tend to just run quickly here at the end of the year. So don't miss out. Review that resource.
Our next question is from Corolla. They're asking, when is someone being forced to switch from an IRA to a Roth?
Well, no one is going to force you to switch from an IRA to a Roth. The, I guess, proper term will be do the Roth conversion, perform a conversion on traditional IRA and move it to a Roth. It's not something that you're ever being forced to do. This is a tax strategy. It depends on a number of factors. Roth conversion may or may not be the right thing for you. Again, it depends on a number of factors such as your current tax bracket. What is the tax bracket that you're expecting to be? What is the horizon for retirement? Are you in your 30s or you're in your 60s, right? So that plays a role. Also, what plays a role is the type of investments you're going to be making with your retirement account. If you're expecting to receive 5 to 10% return on your investment, then that's one situation. And if you're investing in some opportunity and you have a potential of doubling your money in a couple of years, and 50 to 100% return on your money, well, that's a great example of actually doing a Roth conversion before investing in that opportunity, because with Roth IRA, all of the gains and profits and income from the investments that you're making with your self-directed Roth IRA will be tax-free. So again, no one is going to force you. There is no deadline, but it is a personal situation that you want to probably discuss with your CPA. So we can tell you whether it makes sense for you to convert to Roth or not, because we don't know your situation. We are not tax advisors here, but run it with your CPA. Make sure you understand your situation yourself first.
Corolla is also asking, can you use both traditional and Roth IRA to invest in the same property?
Yes, you can certainly use both traditional funds and Roth funds to invest in the same property. If it is we're talking about traditional and Roth IRA, so basically you will need two self-directed IRAs, one self-directed traditional IRA, one self-directed Roth IRA. And yes, it is possible to pull those funds together. For example, one property can be owned 50-50 by your traditional IRA and Roth IRA. Again, it can be a bit tricky, because you're going to have to split all of the income and expenses for that property, but it is possible. And with that in mind, again, I want to plug in a solo 401k, because with the solo 401k, you have built-in Roth feature. In the solo 401k, you have built-in Roth account. So it's basically one plan owns the property. So while you still need to basically track all the income and expenses, but the ownership of the property will be in your 401k trust rather than having two owners, because with an IRA, you will have basically two legal owners for the property, but it's so much easier with the solo 401k. Again, possible if you want to kind of brainstorm and get into details of your situation, you can schedule a consultation, which is complimentary with one of our self-directed account experts, and we can look into that and guide you.
Corolla is also asking, if you buy real estate with a self-directed IRA, where can you get the loans to fund the purchases?
Well, if you wish to finance the purchase of the property inside of your self-directed IRA, you can do that. The rules allow you to finance purchase of real estate. The key that you need to understand is that loan must be non-recourse, meaning that you as the account owner are not allowed to provide a personal guarantee for the property, so conventional loan will not work. You have to use a non-recourse financing. Now, there is a handful of lenders that specialize in this. You can find those lenders on our website. I believe we have it listed under both self-directed solo 401k and checkbook IRA. So again, if you head over to our website, click on Solo 401k and drop down, click on non-recourse lenders. There is not a ton of them, just a handful of lenders that specialize in this. And I'm talking about larger known lenders that actually specialize in this. You don't have to use one of those lenders. You can actually use private money. The cost might be different, but hey, if you have a friend with money in a retirement account and you're looking to acquire a property, well, you can actually make it a win-win. I've done it myself, but you can actually find someone with money in the retirement account and you can make an offer for them. Hey, if you have an IRA that is being sitting maybe in a money market account earning 1%, well, hey, I'm looking to buy a property. You can give secured loan to my self-directed IRA, and I'll pay you 6%. So instead of 1%, you're going to get 6% or 7%, whatever you agree. So that can be a truly win-win. Again, doesn't have to be, a bank or just a lender. You can use private money, whether it's somebody's savings or it's money in a retirement account. But yeah, good question.
Our next question is from Richard. How much can I contribute to my Self-401k Roth plan each year?
Well, the contribution to the Solo 401k depend on your income. So you can actually contribute 23,000, I believe, as elective deferrals. If you are over age 50, there is a catch-up, and then if you're between ages 60 and 63, there is a super catch-up. So if you go to our website, click on the Solo 401k and then click on calculator, it will take you to the calculator page where you can plug in your numbers. You need to know your compensation for the year because contributions are based on the compensation. Plug in your numbers and then calculator will tell you exactly how much you can contribute. It's pretty straightforward. Again, you just need to know your numbers because the year is not quite over yet. It might not be exactly accurate because you got to have your net compensation for the year, but you can get pretty good idea. And then once you finalize the numbers, then you can calculator will give you exact numbers for the year.
Martin is asking, can you explain regarding forced withdrawals?
Forced withdrawals. Martin, there is no such thing as forced withdrawals, but I think you're referring to required minimum distributions or RMD. That's what it's called. I guess it is a forced withdrawal in a way, but just want to make sure we're using the proper terms here. Well, if you reach age 73, there's a required minimum distribution in both traditional IRA and also pre-tax. Okay, the amount of the distribution is based on the balance in your retirement account and your age. So again, there are calculators online. I believe we have links on our website that or you can just Google it, and you just need to plug in the balance in your retirement account and your age, and the calculator will do the rest, will do its job, but that's what it is. Once you reach age 73, for this year, then yeah, there is a required minimum distribution. It does not apply to Roth IRA, and since actually recently it doesn't apply to Roth Solo 401k either. That was not the case until just recently, but it is the case now. So Roth funds are not subject to RMD.
Martin is also asking, what is the impact of missing to submit the 50?
Well, that's a very good question. And can be expensive question. Actually, the penalties for failing to file Form 5500EZ are pretty severe. So that's why we keep emphasizing this. We talk about this with our potential clients before they become clients. We make sure that you acknowledge your responsibility for file this because you are the plan administrator for your Solo 401k plan, and that is your responsibility. We help you complete that, but the penalties can run up to $150,000 a year, I believe. So they're very severe. So you don't want to miss that. It's pretty simple form. It's only 2 pages. You've got plenty of time to do that. The deadline to submit this filing is by the end of the 7th month following the end of the plan year. So again, if your plan year ends December 31st, which is the case for most people, not all, but most, because some people, they have their business fiscal year and let's say March, end of March, or maybe June, or even September. So in that case, then you're going to have to adjust. So again, it's end of 7th month following the end of the plan year. And we do have detailed guidance on how to complete this form on the client portal, and we'll even review that form for you. We had this a la carte service that we offered to actually submit that filing for our clients. In the past, we stopped doing it this year because we just got too busy with clients. We might bring that back again next year, possibly, but ultimately you're responsible for submitting this form, whether you do it yourself or you utilize our service to do it. Make sure that you understand the deadline. It is required to submit if your total plan assets exceed 200. So don't miss that. We have plenty of resources to help you do that. It's pretty simple. If you do it the first year, probably will take you the most time, and then all the following years, pretty much the information will be the same, with the exception of the actual numbers, because your numbers will change from year to year because you're making contributions, you're investing, your balance is going to be growing and changing, but the rest of the information stays the same. So be sure to not miss that requirement.
Our next question is from Kevin. He is asking, what is the difference between employee contributions to Roth 401k and employer contributions to Roth 401k? Both are contained within the solo 401k and handled in regard to the time frame of taking distributions.
Good question, Kevin. Until recently, you could not make a Roth contribution as far as your employer profit sharing contributions, but with the recent changes in the tax law, Congress allowed making a Roth contribution to the employer portion. Again, it's going to be a little bit tricky how that is handled, because the employer, your business, taking a deduction for making the profit sharing contributions. But if they're made as a Roth, then the employer will be responsible for issuing a 1099 to you, because Roth is post-tax money. So it's not taxed directly, but in this case, it will be through 1099-R that your employer will issue for those contributions. But yeah, Roth are treated the same pretty much, and it's a great way to invest. Do it early on. Typically, Roth makes sense the most. The younger you are, the more time you have for your money to grow tax-free, the more sense it makes. But again, everyone's situation is unique, so be sure to discuss this with your CPA if that strategy is right for you.
David is asking, and I believe we had answered this question earlier. This is my first year end with my solo 401k. What reporting needs to be done and by when?
Yeah, so David, we did answer that. Just go to our website, click on the solo 401k, and then click on the year-end checklist, and you'll see exactly what you need to do. And if you need clarification or guidance on any of those items, again, we are here to help. We do offer unlimited support to all of our clients. If you're a client, just reach out to our office, and one of our experts will guide you.
The next question is from Bob. When I buy a mortgage note in my solo 401k, can I pay the closing costs or transaction fee with money not in the solo 401k account?
Short answer is no, Bob, but let me expand on that a little bit. When you're making investment with the solo 401k, a solo 401k must pay all of the related expenses to that investment, and all of the income from that investment must go to the solo 401k. You're not entitled to any of the income or profits from that investment, and same thing, all the expenses, they must be paid from the 401k. They're not your expenses. If you end up paying some of those expenses personally, it will be considered a legal contribution to the 401k. So you do not want to do that.
Eugene is asking, my self-directed IRA needs a yearly fair market value report. Please explain what I need to report.
Well, Eugene, if you have a self-directed IRA, the value of the IRA must be reported to the IRS annually. It's a little bit different than the solo 401k. With solo 401k, reporting is done using a Form 5500 EZ. Use the plan administrator do that. But with self-directed IRA, your custodian is responsible for making or submitting that report. It is done under Form 5498. Again, your IRA custodian is responsible for that. Now, because you have a checkbook IRA, it's either LLC or a trust that your IRA owns, and you are the manager of that LLC. You're making investments, you're running all of that. Your custodian doesn't have the access to those investments. You may set up a checkbook IRA and buy, one rental property with it, or maybe 10 rental properties. And again, your custodian doesn't know what's inside of it. It's controlled by you because, again, you have a checkbook control IRA. But your custodian is responsible for reporting the value to the IRS. And how they can do that is by you providing the value of all of the assets inside of your checkbook IRA. So you should have received by now request from your IRA custodian to submit the fair market valuation. You need to do that by the end of the year. If you fail to do that, you will get penalized. And then if it's drags on, then you're actually at risk of losing your IRA. Your custodian has the right to just close your IRA, and all of that will be considered, or whatever you have in your self-directed IRA will be considered distributed to you. So don't let that happen. Make sure you provide the fair market valuation. Again, it's very simple. You receive the email with the link, click on that link, and you will just list the assets, including the cash. Remember, the cash in your checkbook IRA, if you have a checking account with cash, that's an asset. So the checking account is technically an asset. So you have to list all of that. Then custodian will use that information to submit Form 5500 EZ, which they're required to do by the IRS.
The next question is from Karen. Karen is asking, how do you set up a loan from a 401k trust, and can you do multiple loans?
I'm assuming you're asking about a participant loan. So if you have a solo 401k, you have the ability to take a loan from it. You can borrow from it. The loan can be taken for any reason, any purpose, pretty much any time. And now there are some rules that you need to understand. The loan is limited to $50,000 or 50% of the balance, whichever is less. And you can actually, our plan documents allow up to 3 loans at the same time. Now, they will be subject to the same limit. So you still need to complete loan application, complete the calculator to see how much you can take. For example, if you took a loan for $20,000 last year, and then you wish to take another loan, you potentially can have access to another $20,000 as a second loan, assuming that you have over $100,000 in total value of your 401k, because that's what needs to be factored. Loan calculator will do the job for you. Again, you just need to plug in the numbers, and you'll see how much you can take as a loan, but you can have up to 3 loans at the same time.
Nathan is asking, do you recommend buying equipment before the end of 2025?
Nathan, I believe this is a tax question. Buying equipment for your business, is that what you're referring to? Well, we're talking about self-directed IRAs and solo 401ks here. You don't buy equipment for your solo 401k. You buy investments. You make investments with your self-directed IRA. But if you're referring to buying equipment, then yeah, there is I believe the accelerated or 100% depreciation is back. Trump allowed that. And so I think in most cases that's going to be a good way to get more deductions for your business. But I'm not a CPA. I don't know your tax situation. You got to go back to your CPA and discuss this.
All right. And now we're answering our last pre-submitted questions before we move on to the live questions that we received today. This is from Nancy. I'm 68 and I've had a self-directed IRA for 15 years. It was a real estate investment in a multi-unit apartment building. I'm wondering at what point to sell this property to experience a used amount of taxes. I don't know if there's a limit on how I can be able to keep the property in a self-directed IRA. Most tax people in this part of the country are unfamiliar with this and have been unable to help me. Thank you.
Good question. I'm not sure if I'm 100% following. on this, but if you own an investment inside of your self-directed IRA, now this can be real estate multifamily investment, like in your case, or can be something else. But you got to remember what happens inside of your self-directed IRA has no effect on your taxes personally. So, because you're asking here about some taxes. Again, I'm not fully clear. You're saying here, wondering it's what time to sell the property to experience a used amount of taxes. So I don't even understand what you're trying to say here, but what happens inside of your IRA has no effect on your taxes. Whether you're going to keep this property or you're going to sell the property, that's not going to affect your taxes because you're buying the property inside of an IRA, you're selling the property inside of an IRA. Whether you sell the property today or next year, that's not going to affect your taxes. Frankly, if there is no leverage on the property, then it's not going to make any difference on an IRA itself either. Now, if you do have a leverage, then there might be some UBIT implications. So be sure to run that with your CPA. But again, it looks like you're concerned about your personal taxes, which sale of an apartment building in your IRA will not affect that. Now, I want to piggyback on the question that was asked in the very beginning about RMD. You're 68, so yeah, certainly you do want to be thinking about the RMD at this time. It's just a few years away. So you want to be thinking about that and make sure that you do have a solid plan on how to satisfy the RMD for your IRA, but it doesn't affect your taxes. Again, you're saying that you try to talk to tax people. They're unfamiliar with this. Yeah, they might be unfamiliar with self-directed IRA, but if you're talking about your personal taxes, whether you're taking a distribution from self-directed IRA or you're taking a distribution from just a regular IRA at Vanguard or Fidelity, whatever amount that you're taking out, that you're pulling out, that's the amount that's going to be taxable in that year. That amount will be deemed or added to your earned income, and you'll be paying taxes on that. So it is pretty straightforward, but again, because of your age, you do need to be planning for RMD.
Thank you, Dmitry. We're now about to enter our live questions that we received today. The first question for today from our live chat is from VJ. Is it worth contributing to cash balance plan along with a solo 401k, pros and cons, and also what needs to be done to contribute?
Well, yeah, the cash balance plan might be worth it. It might be a good option. It works well with the solo 401k. You got to remember that your profit sharing contributions to the solo 401k will be impacted. They'll be lowered because you have a cash balance plan, but you do need to speak with your cash balance plan administrator and actuary. We do have a resource for that. We can refer you, but yeah, that might be a good option to reduce your tax liability even further because you can shelter more of your income. But yeah, it's mainly the only effect on the solo 401k is the profit sharing contributions. But again, you got to talk to the actuary of the cash balance plan, the company that set that up for you. Again, we can provide a referral for this.
The next question is from Josh. For the voluntary after-tax contribution, do you assist with the preparation of the 1099-R?
For voluntary after-tax contributions, again, that is handled by you as the plan administrator. Our role is a document provider. So we handle the plan documents, but you remember that you are the administrator. So we will help you with the 1099. We don't file it for you, but we do have a resource on how to complete that. We have a very useful resource. You can access that on the client portal. Again, just another plug for the client portal. This resource has answers to probably most of your questions because somebody else probably asked this before. So if you have a question, you can certainly ask it here. This is a great way for you to learn and even spread this to other people so that other people learn. But a client portal is another great resource. Go to the client portal and then head over to or click on knowledge base and just type your question and you'll probably find the answer there. And the resource for 1099 is there as well.
Josh is also asking, does the voluntary after-tax contribution show up anywhere on the W?
Voluntary after-tax contributions are not done through the payroll. They will not be showing up on the W.
And our next question is from Richard. I have a half-time job, some else, and my sole 401k only has me for the moment. Can I add a Roth 401k account in my plan for my wife who has a full-time job elsewhere?
Well, Richard, if you are self-employed and you have a job elsewhere, that's fine. As I talked about in the beginning, one of the first questions here, you can certainly have a solo 401k for your side business or your self-employment activity. But in order for your wife to participate, your wife must be employed in your business and receive compensation. So if your wife is not part of your business and she just has a job elsewhere, she's not going to be able to participate, let alone contribute to the solo 401k. So that's not going to work.
Daniel is asking, regarding the capital gains, does the same thing apply with a solo 401k?
Daniel, there is no capital gain taxes on the solo 401k because solo 401k is tax deferred retirement plan. So what happens in the solo 401k when you, let's say, make an investment and then you sell that investment, all of the gains from that investment will be sheltered from taxes. Now, the distributions from the solo 401k will be taxed at ordinary income tax, and you're going to be responsible for that, but there is no capital gain taxes in the solo 401k.
The next question is from Gary. If one is making voluntary after-tax contributions to the solo 401k, does income still matter?
Well, income absolutely does matter for making contributions to a solo 401k because contributions are made from the income, from the profit specifically. So you have to determine your compensation in order for you to contribute. So if there is no income, you're not going to be able to contribute. So yes. Leah, I think you might have muted yourself accidentally, but I see the question here, when is the 5,500 is due? Well, that is due by the end of the 7th month, as I explained earlier, following by the end of the plan year. Again, in most cases, if the plan year ends on December 31st, then you have until July 31st to submit the Form 5500 easy. And if your plan year end different, then you want to make sure you adjust that. But that's your answer.
And Daniel is asking, and I believe we answered a bit about this earlier, how much is it for you to do the 5500 easy for us?
Well, currently we do not offer this service. Again, this year we have done it in the past. We don't do it currently. We might bring that back because we had very busy year this year, and just our resources were pretty thin that we can allocate them to this particular task. We might bring that next year because we added some team members to potentially assist with this, but we are still evaluating that, and as of right now we don't offer this service.
Our next question is from Josh. Assuming total contribution limits of $70,500, is there any reason to do an employer contribution? For example, why not do $23,500 employee elective and then the remaining as voluntary after tax, assuming I want to do all Roth contributions?
Yeah, so the way that you want to make contributions is that you want to contribute, maximize your employee elective deferral contributions, and then on top of that, you want to maximize the profit sharing contributions, which can be converted or can be actually made as Roth, or if you made those pre-tax. So that's actually a very nice thing about the the profit sharing contributions, because they can be made pre-tax. You can get a deduction for the business if needed, but if you choose to convert it to Roth, you certainly can do that. So because you got the flexibility there. And then if you do have the income to do even more contributions, then the balance can be done as after-tax contributions.
Our next question is from Liz. If you have loaned out monies in your plan and doesn't exceed the 250K requirement by year end, do you still need to file the form? I believe this is referring to the 5500 easy.
Run that question again for me. Well, the Form 5500 easy is based on the total plan assets in the solo 401k. So let's say you had $300,000 in your solo 401k, and you lent $80,000 out. You made a loan from the 401k, and then you only have $20,000 cash left. It's not based on the cash that is left. It's based on the total plan assets. So what are the total plan assets? Well, you got a loan out, value $230,000, plus you have cash for $20,000. 280 plus 200, that's $300,000. So you're above the threshold and you must file Form 5500. Again, I'm using a simple example here. You might have multiple assets, but the bottom line is you have to add up all of the assets. And if the total is over 250, you must file it. We actually recommend filing this form regardless of your total plan assets, even if you're under 250. It's just a good idea and a good practice to submit this form, because you get in the habit and you get the record established with the IRS. So do that regardless. Very simple. Doesn't cost you anything, but you get in the habit, and when you will be required, it's going to be a piece of cake.
And our final question for today is from Josh. Are you saying for a Roth employer contribution to the employer is required to issue a 1099-R to the employee?
Yes, if you're making Roth profit sharing contributions, because remember, the profit sharing contributions are tax deductible for the business. So you get a tax deduction, but this money comes to you as a Roth, and otherwise it's after tax money. So you have to pay taxes on the contribution. So let's say business is contributing $20,000 contribution, profit sharing Roth contribution to you. Well, the $20,000 is tax deductible for the business. So it's not after tax. You have to pay taxes on this. And in order for you to pay the taxes, then that needs to be reported as a taxable income. So the way to do it is for the business to issue a 1099-R to you. IRS knows this is a taxable income that will be reported on your tax return. You're going to pay taxes on that. So yes.
All right. I believe that is the last question. We just got a new question from Shalifewell. Do you have steps on how to put on a solo 401k?
Well, we absolutely have steps on how to set up a solo 401k, I'm assuming. Yeah, so you do want to reach out to our team and speak with one of our experts who will guide you. But to summarize, in a nutshell, you need to be eligible, because solo 401k is not for everyone. You must have legitimate business or self-employment activity that generates earned income in order to set up a solo 401k. So I guess that will be step number one, or requirement number one. Then you want to make sure that you don't have any employees, nothing that will disqualify you from a solo 401k, because if you do own a business and you have full-time employees working for you, then you will not be eligible for solo 401k. So if you do meet, then contact our team, engage our services, and our team will create the plan documents. Your business will adopt the 401k plan. We'll provide you with all the IRS approved plan documents, including the resolution for your business to adopt the plan. You sign it, your plan now is in effect, gets registered with the IRS, and then you can make contribution and take advantage of all the great benefits solo 401k has to offer.
Thank you, Dmitry. We do have a couple more questions coming in. The next one is from Tina. Besides helping to set up the 401k and IRA, what other services does your company offer?
A very fruitful day today as far as the questions. Well, that's our specialty. We set up solo 401ks and IRAs. That's all we do. So we do not offer any other services besides checkbook IRA and solo 401k.
Vern is asking, please talk about returning funds from an investment to an IRA.
Well, yeah, good question. But it's pretty straightforward. If your IRA made an investment, then once the investment concludes, or depending on what investment that is, let's say you invested in a trust deed, so you lend the money from your solo 401k to a third party. Well, assuming this is a secured not a secured loan, and when the property, let's say, sold or refinanced, then basically you acting as a bank, or your IRA acts as a bank. And when the loan is paid off, it's probably going to be done through escrow, typically. So the escrow will request your information, where to send a payoff. So the payoff has to be sent to your checking account for your checkbook IRA. It's very simple and straightforward. You have no other option. These funds cannot come to you personally. They must go to the lender or investor. In this case, will be your checkbook IRA, whether using LLC structure or a trust. So it must go back to that checking account. The same concept if it's a different investment, but the same concept.
All right. I believe that would be our final question for today. And thank you so much for everyone for tuning in and typing in your questions. It was really great for us to answer your questions. And thank you again to Dmitry for being here to answer their questions.
A great day. Enjoyed being with you here, Leah, and answering the questions. Thank you for all who participated. Again, not only you benefited, but everybody else benefited from your questions who are on the line, but also it's going to go on our YouTube and eventually on podcast, and other people will listen and benefit from your questions. Thank you, and have a great rest of the week, and we'll see you at the next session.
Thank you, everyone.